Have you ever been looking at your investment statements and seen that little Greek letter, beta? It can look kind of intimidating, right? But it's actually one of the most useful tools you have. So in the next few minutes, we're going to crack the code on beta and show you exactly how to make it work for you. So what is this number actually trying to tell you about your money? Well, the simple answer is it's a measure of risk and potential reward. You can almost think of it as describing the personality of your fund. But to really get it, we've got to start with the basics. All right, first things first. At its heart, beta is simply a way to measure how a fund moves. But the key, the real key, is understanding what it's moving in relation to. At the end of the day, beta is all about volatility. It tells you how much a fund's price tends to swing up and down compared to the overall market. Now, analysts use some pretty heavy-duty math, like regression analysis, to figure this out against a benchmark, say the S&P 500. But I like to think of the market as a big ocean wave. Beta just tells you how high or low your specific boat is likely to ride on that wave. Okay, so beta isn't just some vague concept. It's a specific number that tells a story. And that story always starts with one single crucial number. And that number is 1. You got to remember this. The overall market, whatever benchmark we're using, is defined as having a beta of exactly 1. That's our anchor, our baseline. Every other fund's beta is measured against this standard. So check this out. It's actually super simple. A beta of 1 means your fund basically moves in lockstep with the market. If the beta is greater than 1, say 1.2, it means it's more volatile. And if it's less than 1, like 0.8, you guessed it, it's less volatile. It seems almost too simple, but really understanding this is a total game changer for managing your portfolio. And here's where things get really interesting and where you need to pay close attention. Beta's effect isn't just one way. Nope, it's a double-edged sword. And it can amplify both the good times and, well, the bad. Let's imagine a great day in the market. Everything's up 10%. Awesome. That fund with a high beta of 1.2, it amplifies that gain and jumps a whopping 12%. You're outperforming the market. That feels fantastic, right? But what happens when the tide goes out? And here's the flip side. If the market drops 10%, that same high beta fund now magnifies the loss, falling 12%. But look over at the low beta fund, the one with a 0.8 beta. It provides a little bit of a cushion, only falling 8%. This shows the trade-off perfectly. So what's the big takeaway here? It's simple, really. A higher beta means higher potential returns, sure, but it also means higher potential risk. It basically turns up the dial on everything. Getting this relationship is the key to using beta wisely. Okay, so theory is great, but how do you actually use this? How do you take this knowledge and apply it to your own investments? Well, it all comes down to matching a fund's beta to your own personal situation. So before you even look at a fund's beta, you have to ask yourself a really fundamental question. What kind of investor am I? Are you looking for aggressive growth, or are you more conservative? Is your timeline long, or is it short? Your answers are going to point you in the right direction. So let's break this down. You've got 2 classic paths here. If you're young and building wealth for the long haul, you might lean towards a higher beta fund. You know you have time to ride out the ups and downs for that potentially higher growth. But if you're getting closer to a big goal like retirement, a lower beta fund that's all about stability and a smoother ride probably makes a lot more sense. Now, if all those numbers are making your head spin a little, don't worry. I want to leave you with a simple but really powerful analogy. It's the easiest way I know to remember what beta is all about. Just think of beta as the volume knob on your investment portfolio. A high beta fund, that's like turning the volume way up. The music is louder, the highs are higher, and the lows are lower. It's just more dramatic. A low beta fund is like turning the volume down. The music is softer, the ride is smoother, and those big swings are way less extreme. So look, if you walk away remembering just one thing from all of this, let it be this. Beta tells you how much your fund can swing. That's it. It's a measure of risk that, once you get it, can empower you to make smarter choices that are right for you. So the real question is, how loud do you want your music? And finally, one last and very important thing to keep in mind. This conversation is just for educational purposes. All mutual fund investments come with market risks, and it's always a good idea to chat with a qualified professional before making any big investment decisions.